Ladies and gentlemen, so welcome to this first panel in this highly interesting conference on turning points in history. My name is Jan Kranen. I'm a professor of finance at the Goethe University in Frankfurt, and I'm very happy to have the opportunity to chair this illustrative panel. Let me say a few words as an introduction to this first part of the conference, which will deal, and quote from the program, how did central banks contribute to the stability of the financial system? So one of the key questions that Jens Weidmann in his welcome speech was mentioning. In my opinion, there's hardly any doubt that we are once again at a turning point in financial and monetary history, actually in exactly these days. So the timing of the conference, if I consider the title, seems to be well chosen, although certainly fixed a long time ago. The specific historical constellation that we now are facing poses extraordinary challenges to monetary policymakers, in particular in the Eurozone. And I just mentioned four aspects that I think all happen at the same moment. We have the great expansion of unconventional monetary policy, unseen and at least in this part of the world. We have an active role of the central banks in stabilizing the banking system, which itself is subject to higher systemic risk than in earlier times. Thirdly, we have national governments with unsustainable debt levels, at least in some countries in our zone, our monetary zone. And finally, we have a monetary union without a political or a fiscal union. This constellation leads to a lot of pressure on central banks to substitute for a lack of political action. And this is, I think, what we are now experiencing to a large degree. Monetary policy, I quote Ernst Baltensberger, a well-known economist from Switzerland, has become a playground of experiments, and we are in some sense watching it and trying to make sense of it. It is this remarkable interplay of monetary policy and financial stability which we still don't understand very well, and I can only say from an academic viewpoint that this is a lot of ongoing work, but policymakers have to act with the little knowledge and understanding that they have. So this seems to be a very good moment to hold in for a second and to take a deeper look into history and into the experiences of other countries in search for lessons and inspiration. So it is my great pleasure to welcome three outstanding panelists that will share their insights with us as well as their experiences. All three share an outstanding double career in academia and in monetary policy institutions. Charles Goodhart from the UK, Marvin Goodfriend from the US, and Claudia Buch from Germany. I will introduce each of them before they speak. So let us remind of our topic, how did central banks contribute to the stability of the financial system? The first speaker will be Charles Goodhart, who has been a member and is a member of the Financial Markets Group and an emeritus professor at the London School of Economics. He was the director of the Financial Regulation Research Program at FMG. Charles Goodhart holds a PhD from Harvard, and he's now one of the most influential monetary economists with important contributions in monetary policy, banking, and regulation. So the entire field of challenges that we are facing has been covered in his work. He has been a key advisor of the Bank of England since 1969 and also an external member of its Monetary Policy Committee for many years. He has worked with equal intensity on monetary economics, financial regulation, and banking. In the current crisis, this has given particular weight to his assessments throughout the last couple of years, and we have been meeting in so many events before. So Charles, please, if you would start with your experience from the UK on our topic.
Thank you very much, Jan-Peter. It's a particular pleasure to be here because I began as a monetary historian. My early work was about the US and the UK financial conditions before World War I. Those who do not respect history are more or less condemned to repeat it, though I think probably we're repeating it pretty much anyhow. It's not so much turning points, but rather similar stages in a sort of financial cycle that comes and repeats. And after all, the problem that the early monetary thinkers in the UK were dealing with, people like Henry Thornton, whose book, The Paper Credit of Great Britain, is actually far better than Walter Bagehot's Lombard Street. The problem that they were dealing with is how do you combine adherence to the gold standard with the maintenance of financial stability? And that is, after all, more or less exactly the same problem that we're all wrestling with now. How do you combine adherence to an inflation target, membership of the Eurozone, with financial stability? Now, the answers that Thornton and Bagehot came up with when you had a dual outflow, because most crises led to an external outflow because of adverse flows across the exchange when there was a crisis, and an internal outflow as people took gold out of the banks, was to try and introduce a lender of last resort. Initially, the term the lender of last resort could be interpreted in two ways. The first one as the only institution which was still prepared to undertake lending on a large scale. And the second meaning of lender of last resort was when a particular borrower couldn't get finance from any other institution. And initially, when it was coined by Evelyn Baring, I think that the key meaning was the first, when no one else other than the Bank of England was prepared to undertake any large-scale lending. But over time, the meaning of lender of last resort has tended to move towards conditions in which a particular borrower can't raise funds from any other source. Now, the difficulty that that second interpretation and meaning has brought about is that if an institution is self-evidently incapable of raising funds from anywhere else, it's obviously in great difficulties. And that means that there has been a stigma attached to the utilization by an institution of lender of last resort. Let me take a particular example. In, I think it was August 2007, Barclays Bank, as a result of some unexpected large-scale cash outflow, had to revert on a particular evening, late afternoon, to the Bank of England for some money just to cover over a very temporary cash flow problem. And this became discovered because it showed up in the Bank of England data that the Bank of England was providing a kind of support. And the journalists rang round to every other bank and said, was it you? And each of the other main banks said no. And Barclays said, I'm not going to comment. And the journalists took their own advice. And this had sort of an immediate adverse effect on Barclays' share price and reputation. And it happened again, sort of a few weeks later, at which it is reputedly, because this is second-hand, said that the management of Barclays told their Treasury Department that if this ever happens again, it is a sackable offense. So that there was and remains, in most cases and in most countries, a serious stigma problem about actually going to the central bank for lender of last resort. Now, how do you deal with that? And in a sense, we're still struggling with that. One way is to try and reduce transparency. And indeed, in the UK, there has just been a institutional change made, whereby the Bank of England data do not now reveal circumstances in which people can observe that somebody has applied for lender of last resort support. It's quite difficult in the present context in which transparency is regarded as almost in all cases and in all places desirable to move in the opposite direction. Also, there are difficulties because the stigma attached to lender of last resort application is now so large that in certain circumstances it can reflect a material change in an institution's position. And it is quite difficult for that institution not to reveal it at some stage. Alternatively, what you can try and do is introduce a buffer between yourself as a central bank and the banks that need to borrow. And this was done by the British by establishing a buffer set of institutions known as the discount houses, which played a large role in limiting the application of individual banks to the central bank, but allowing central bank support to flow through to those that needed it without the bank needing it being particularly identified. Now, what we're also doing is trying to cause banks to hold a larger buffer of liquid assets themselves, the LCR, or liquidity coverage ratio, which I have always actually interpreted as being a be kind to central banks ratio. Because essentially what the LCR does is gives the central bank time to see what needs to be done and to discuss with the bank involved, which is having to dig into its LCR, without being faced on a Friday afternoon with the need either to support or to find that that bank runs into failure on the Monday morning. Nevertheless, the stigma issue has meant that over time and over history, I think that the judgment, at any rate my judgment, is that there has been it hasn't been there's too much application to the central bank for financial support under a lender of last resort, but much too little and too late. I would add in this respect that I think that the development of stress tests has been and remains and should be in future an enormous benefit, because stress tests enable the authorities, in particular the central bank, to see how individual banks would find their position under certain circumstances which might happen in the prospective future, in time for the central bank and the authorities to introduce and put in motion measures which would strengthen banks which might otherwise be in difficulties. Even so, even despite the problem of stigma and the lack of willingness and speed of banks to go to the central bank when in difficulty, there is perhaps still some concern about the excessive risk of banks reducing their liquidity support and their liquidity provisions against the prospect that the central banks might be providing them with support. I have to say in this respect that the Bagehot rules, because Walter Bagehot talked about this quite a lot, have been very widely misinterpreted. Bagehot is supposed to have said that you should never lend to insolvent institutions. Well, the Bank of England at that time had no way of assessing whether the institution to which it was lending was solvent or not. The Bank of England at that time was still undertaking a large amount of private sector business and was a competitor with the banks that also banked with it. As a result, the Bank of England would not have been and was not welcomed as a supervisor either to see the books or across the doors of these other banks. So the Bank of England had no way at all of assessing the solvency of the institutions to which it was lending. In Walter Bagehot's book, which I've taken I've taken the precaution of bringing with me, what Bagehot actually means is that you should lend to an institution which has good collateral. In other words, what the concern was with the quality of the collateral on which the central bank was to lend, not the solvency of the institution itself. In any case, the question of whether an institution is solvent is a horribly fuzzy concept, which depends on the context in which you're taking it. It depends on the institutional detail of how the accountancy is being done. And it is indeed, as Ben Friedman will tell us later, it's also endogenous to how the central bank itself is operated. As Jens the President was saying just now, are the Greek banks solvent? Was Northern Rock solvent at a time when the housing crisis was clearly coming upon us? Dodd-Frank says that you should not lend to an insolvent non-bank, but the question of the solvency shall depend in some ways on the self-certification of the CEO of the institution to which the central bank is lending. Then there is a suggestion that Walter Bagehot talked about a penalty rate. He never did. He actually talked about a high rate. And what he meant by a high rate was a considerably higher than normal. Now, in that particular period, a normal rate of the Bank of England was somewhere around 5 or 6. So what was meant was a rate that was 6, 7, 8, not a penalty rate at all. And while we're just talking about comparisons, Jan, you were talking about debt being unsustainable. Do you recall what the debt ratio of the UK was in 1815 when we left the Napoleonic War?
Not at the moment.
You don't recall? Well, I'll tell you. Actually, I can't exactly remember. It's either 260% of GDP or 280% of GDP. I can't quite remember which indicates that quite what is sustainable depends on circumstances. So what protects us against the moral hazard of a banks going to the central bank too often for support and therefore limiting their own liquidity? Well, reputation and stigma, I think, is the first one. The second one is that central banks have tried, from time to time, as the Bank of England did, to involve the private sector. In the case of Barings in 1891, the Bank of England not only provided support, but got a joint support from the group of other banks. Again, we did that, or the Bank of England did that, in the fringe bank crisis in 74, 75. It ended with Johnson Matthey banking crisis in the early 1980s, where again the Bank of England tried to involve the rest of the major banks in London to join with it in the support of Johnson Matthey Bank. The problem was that the US banks said it was not in their interest and feared or claimed to fear that they might get sued by their shareholders in America if they used money to support somebody who might eventually be a competitor of them. And if the American banks wouldn't join in the common institutional support in conjunction with the Bank of England, then all the other foreign banks said they wouldn't do it either. And what was left with Johnson Matthey banking was that the UK clearing banks said, yes, we will help this time, but we will never, ever do it again in future. And this was done to some extent in the US with LTCM, where again it was a joint exercise. And one of the questions, I think, remains whether and how a central bank can involve the rest of the banking system in a globalized world in which there are many foreign banks to provide a degree of joint support for banks and financial institutions that run into difficulties. And then there is, I think, a precept that the first bank that gets into trouble is probably the worst, and therefore you should try and be toughest to it. And certainly, in the case of Baring's second, when Baring's went under because of Nick Leeson, Eddie George was entirely prepared to let Baring go. But at the same time, he was very concerned about the possibility of some contagious effect on the rest of the accepting houses in the UK, and had prepared against the possibility of a contagious effect on other similar banks, and was preparing to step in to support with very considerable strength in the case of a second round effect. But against the problem of moral hazard, one's always got to be concerned with the problem of contagion. And I'd like to end on that. There is a view that what a central bank should do is to lend into the market, not to lend into it to an individual institution, and allow the market to choose where the central bank funds should be applied. Now, in my view, and this is where I will end, I think that that completely fails to understand how a market operates in a panicky condition. What happens in a panicky condition is that the market looks round and says, X has got into difficulties and is gone or is going. Who is the next in line to go? So that if a central bank lends into the market when X has failed and Y is the next to go, the market won't give any money to Y because it thinks that Y is in danger. So when you lend into the market in a panic crisis, you will find that the money goes to the good guys who don't need the money, not to the people who are in worse position who do need the money, because that's the way the market operates. And the market, in a sense, is like a sort of pack of wolves under these circumstances, and you're trying always to bring down or to short the worst sort of young calf at the back who can't run fast enough. So lending into the market as a whole, rather than the institutions who actually need it, simply won't work. You will just go from one to the other, and the panic will get worse. So, as always in these circumstances, one has to try and provide a balance between moral hazard on the one hand and contagion on the other. My own sort of interpretation or view is that in most cases of panic and crisis, we've been far too worried about moral hazard and not sufficiently worried about contagion, but that's my sort of personal position, and others, and this is where I hand over to Marvin, will no doubt differ.
Yes, thank you, Charles. Can I maybe just... Yeah, let me just follow up with one little question to your statement on this very last point, that just funding or floating the market and rather than a particular institution might even aggravate the situation for that single institution, but couldn't it be that flooding the market helps other institutions to take over the activities of the one that seems to be weak?
Well, remember that the other institutions won't necessarily know quite how weak it is. And, you know, let's go back to Greece. Would you buy a Greek bank at the moment, assuming that you had the money? Say you were in charge of a profitable German bank. Would you buy a Greek bank at the moment?
Well, maybe this brings us to the political dimension. We have different systems, and we are not under one legal system that might make it difficult. So thank you. So we move on to the second speaker, Marvin Goodfriend. He's the Friends of Alan Meltzer Professor of Economics at Carnegie Mellon's Tapper School of Business. He holds a PhD from Brown University and has, as all the other speakers here on the panel, the academic and the policy background. Let me say a few words on that so that we can put this in perspective. His work focuses very much on macroeconomic fluctuations, money and banking, and international finance. He was, before coming to Carnegie Mellon, the director of research and a policy advisor at the Federal Reserve Bank of Richmond, with regular attendance of the Federal Open Market Committee at the Board of Governors of the Federal Reserve System. So he has been very closely involved in the thinking and decision-making at the Fed. He also served as a senior economist at the President's Council of Economic Advisors at the White House. He's published widely about federal research policy and history and effective central banking, and also more specifically about inflation targeting, so about monetary policy itself. I think he's the ideal person to bring the US experience into the room, into our discussion here. Perhaps also the early US experience that led to the formation of the Federal Reserve System. But I don't know whether you will do this, but the floor is yours.
Okay. Let's see. How do I start my slides? I'm supposed to. If I push next, maybe it works. Oh, and okay, I don't see them either. But okay, that's fine.
No, we move this.
Oh, you. No, that's okay. I have a paper copy.
You have a paper copy?
Yes. All right. So.
We still need it over here, right?
They're up there.
Oh, over there.
Okay. So I'm going to give a presentation that keys off the conference topic, how crises have changed tasks and practices of central banks, and in particular from the Federal Reserve perspective. And I'm going to hit on some themes. I'm going to talk about monetary policy and as distinct from credit policy of the central bank, and as they both relate to fiscal finance. And my themes will become clear as I go along. So I'm going to tell a tale, a cautionary tale. And I don't know if you see the first page of my slides. The title of my slide is not there, but the title is "The Federal Reserve's Inconsistent Contribution to Macro and Financial Stability." I like the word inconsistent. Thank you, Mervyn. Okay, so the story begins with World War I. The Federal Reserve's first job out of the box was to help finance the war effort, not to do monetary policy. And it financed the war with inflationary policy and immediately ran into its minimum gold reserve constraint and created famously a recession in the early 1920s by raising interest rates openly to do its job as it understood its job. The result was traumatic, and the Fed did not do open interest rate policy until 1994 after that. That's a long story, which I don't have time to go into. But what I do want to mention is what the Fed did in practice to give itself the leeway to do independent interest rate policy or monetary policy. It loosened the link between interest rate policy and the gold reserve constraint in the 1920s. The Fed did this by building up what was known as free gold. It was willing to hold gold beyond the minimum gold reserve requirement and built up free gold in the 20s and 30s that was famously discussed by Keynes, among other people. And by doing so, it would allow the gold reserve to fluctuate above the minimum, basically taking care of the gold standard and then giving itself the leeway to do what we would call independent monetary policy. Why did it do that? The Fed's first job was financial stability. The gold standard was supposed to take care of price stability, and the Federal Reserve decided that it would use the leeway created by acquiring free gold to smooth interest rates. The job was to eliminate spikes that had occurred between the Civil War and the founding of the Fed in the financial markets that were over 10 percentage points in a matter of weeks on 8 occasions, 5 of which were associated with banking panics. So the first job of the Federal Reserve was to stabilize financial markets by acquiring free gold. Now, in doing so, the Fed introduced a highly persistent short-term interest rates which had been unheard of in the US economy. Sounded like a good idea at the time, but eventually led to unstable, adverse inflation and employment consequences, what we now know as the Great Depression and the Great Inflation. So right off the bat, you have a conflict between financial stability and macroeconomic stability that the Federal Reserve kind of blundered into in a way. In a way, it was given this discretion to deal with financial stability without fully understanding the consequences for inflation and unemployment. That's the first lesson. So the Fed was set up in the public interest, given operational independence over its balance sheet, and financial independence to fund itself from interest income. Why is this important? Well, the Fed would transfer interest income to the Treasury after its expenses. And one of the expenses that the Federal Reserve chose to incur was to acquire free gold well above the required minimum, which was costly for the Treasury because gold did not pay interest. The reason I mention this is a first instance of the interaction of fiscal policy and monetary policy. Effectively, what the Fed was doing was withholding or depriving the Treasury of interest income in order to provide financial stability by stabilizing interest rates, is disconnecting itself from the gold standard. It's a little arcane, but it sets up the themes that I'm going to talk about that carry through the century. And it's kind of like, follows on what Charles was saying about what the Bank of England was doing, and I'll come back to the Bank of England in a minute. So I want to continue with the monetary policy story because the next lesson has to do with what I like to call go and stop monetary policy. The Fed was operating in the public interest in a democratic way, so to speak. And doing that didn't prove to be a terribly good idea. In the 1960s, the Fed had created enough inflation to eliminate free gold, and the Congress simply got rid of the minimum gold requirement. And then we floated the dollar in 1973. And in my perspective, the Fed was then subjected to incentives that produced increasingly inflationary go-stop policy by being responsive to the public's mood, in effect, by being democratic. So acting in the public interest, the Fed was inclined to be responsive to shifting public concerns. It seemed reasonable at the time, prioritize low unemployment over low inflation. This seemed, if you go back and read the period of what the Fed's thinking in the 60s and 70s, this seems eminently reasonable. Of course, it took a revolution, an experiment, some great economists to point out the problem with this. And the problem was, if you wait for the public's mood to be favoring inflation fighting relative to unemployment, it's too late because pricing decisions already embody higher inflation expectations that in order to counteract, you have to raise interest rates and create a recession. Now, the problem there is once you raise interest rates and unemployment starts to rise, the public quickly flips back to being concerned about unemployment. And the history, not surprising in the way I'm describing it now, was that the Fed would settle for higher trend inflation with each stop-go or go-stop cycle. That's the kind of thing we've learned all around the world to stay away from, however tempting it may be. Now, Paul Volcker used to say at the end, the Fed eventually lost room for maneuver between inflation and unemployment. And that's essentially why Paul Volcker decided to take on the cost of disinflating the economy in the early 1980s. If you read the transcripts, he's always talking about the room for maneuver is closing in. So Volcker decided that it would be better to reverse the priorities and just justify actions against, to stimulate employment against a commitment to low inflation. If you ask Paul Volcker why he was doing this, was he a committed theorist? He wasn't a theorist. He was a guy who had lived the history. So he would be a person that would appreciate this conference, learn the history, understand what happened in order not to repeat it. So Volcker succeeded in reducing inflation, but it was far from clear whether interest rate policy could keep inflation low without persistent recessions. But in fact, that proved to be doable in the so-called Great Moderation. And in the 1983-84 period and in 1994, the Fed raised interest rates for the first time without a prior increase in inflation. This seemed crazy to people who were just looking at central banks, and yet it seemed it was the right thing to do. to perpetuate low inflation and low unemployment. And in 2012, the Fed adopted an inflation target. I mean, to me, it's amazing how long it took the Federal Reserve to adopt an explicit inflation target, but I'm happy that they did. So I want to go on now and talk about Federal Reserve credit policy. Credit policy is a different animal than monetary policy. Monetary policy, the way the Fed understood it, was simply allow money to move around to smooth interest rates in a way that you could stabilize inflation and unemployment. Credit policy is about the central bank essentially in the United States, selling a treasury security and taking the proceeds and lending the proceeds to a bank or some non-treasury agency. The story of Fed credit policy is interesting because the century of Fed credit policy is one where the independence to do credit policy was loosened considerably over time with some problems that I want to address. It's interesting to go back to the beginning. In the beginning, the Federal Reserve Act authorized the Fed to extend credit only to member banks. The Great Depression saw this famous Section 13.3 of the Federal Reserve Act amended to give the Fed authority, famously, after the crisis in 2007, to lend to individuals, partnerships, and corporations in unusual and exigent circumstances. But what people don't realize is that in the 1930s, the restrictions were so great as to make the Fed unable to exercise that famous authorization. There were highly restrictive collateral requirements. Congress respected the idea that the independent Fed should not be given unbridled, or very much, authority to make credit decisions. We forget that. And I want to tell the story about how we went from there to where we finally got to. So what the Congress decided to do was to establish the Reconstruction Finance Corporation in 1932. This is a corporation that was designed to do credit policy. That credit policy authority was not given to the independent central bank. When I first understood this, I just had to get up and walk around the room because it was so different to the world we live in. So it's fair to say that credit policy was regarded as fiscal policy, even in the Great Depression, or in the Great Depression. So, continuing the story, following the 1987 October stock market crash and the 1980s period of U.S. banking turmoil, the Board of Governors asked Congress to amend the Federal Reserve Act in the 1991 Fiducia Act to grant, in Alan Greenspan's words in one of his recent papers, quote, virtually unlimited authority of the Federal Reserve to lend in unusual and exigent circumstances. In other words, the Board of Governors in 1991 asked and received from Congress a lifting of these restrictions on the Federal Reserve's power to make credit policy allocations more broadly in the system. So I have in my notes here saying, I thought this was terribly ironic, since Alan Greenspan was one of the people, along with Paul Volcker, to recognize the virtues of self-discipline with regard to inflation, but didn't recognize the virtues of self-discipline with regard to credit policy. This is another moment when I realized, wait a minute, I got up and walked around the room and tried to put this into my head. So subsequently, continuing with the story, computing information, technical progress, regulatory capital arbitrage, Securities and Exchange Commission regulatory permissiveness, securitization, structured finance of illiquid cash flows. If this were a movie, you'd be montaging through all these things in a very rapid succession, seeing the future unfold. I think this was terribly, there's every reason to believe that this kind of expansion of shadow banking, or what we call money markets in the United States, was facilitated by the 1991 expansion of the Fed lending authority. Fed lending reach was not accompanied by the Federal Reserve's supervision and regulation of money markets and shadow banking, however. That authority rested with the Securities and Exchange Commission. In Pittsburgh, we have a team that plays football called the Steelers. And if you know something maybe about American football, or maybe even about soccer, we have something called zone defense. A zone defense works great, but if you use a zone defense alone, then you're playing against another team, that team knows to go right up the middle of the zone because it confuses who's responsible for the territory between the zones. Well, in the United States, we've allowed regulators to play zone defense for 100 years between the SEC and the Federal Reserve. The money markets and shadow banks set themselves up between the two zones. Now I want to connect with Charles. I think I'm doing pretty good. I want to talk about Bagehot's rule. Charles mentioned it briefly. Bagehot's rule worked for the 19th century Bank of England, but does not discipline Fed emergency credit assistance. Lend freely at high rate on good collateral in the way that Charles described it worked for the 19th century Bank of England because the problem was not to satisfy the public's the problem was to satisfy the public's desire to convert deposits into currency at bank rate ceiling. The Bank of England needn't assume credit risk to do so. Even though this policy was called lender of last resort, it was essentially a monetary policy, one of the great confusions in the history of central banking, in my opinion. The private Bank of England earned profit and bore the losses, so it would lend freely at high bank rate, be happy to have a high bank rate, against abundant safe bills of exchange or consols, disciplined by occasionally the UK Treasury's relaxation and reimposition of minimum gold reserve requirements. In effect, in this brief time I have to make this point, Bagehot's problem was to encourage the Bank of England to lend freely at a high bank rate in a banking crisis. In my view, and I'd like to hear what Charles thinks about this, this was needed to overcome what the Bank of England might have felt reluctant to profit in a banking crisis. I've not found a smoking gun on this point, but it makes sense to me. Well, what's the Federal Reserve's problem? The problem in the Federal Reserve's case is exactly the opposite. It's to limit the independent Fed's expansive lending in a financial crisis. Why? The Fed is inclined to lend even against poor collateral at an inordinately low interest at times, rather than risk a panic in a crisis, because its own funds are not at stake. It's not a private profit-maximizing group that has to respect its own residual claimants. The Fed has the implicit backing of taxpayer funds to absorb losses. Now, it's important to know that the Fed puts taxpayers at risk even if it protects itself by taking good collateral. The reason is if the entity to which the Fed lends fails with a Fed loan on its balance sheet, the Fed takes the collateral right off the top at the expense of taxpayers who may be exposed to losses from backstopping the deposit insurance fund or from other financial guarantees in place. It's important to know that this problem that I'm describing was really exacerbated in the post-World War II period. Why? Because in that period, the federal government had much enhanced access to financial resources by the willingness of the United States to employ the income tax to a degree that had never been imagined before. And second, with the demise of the gold standard constraint was eliminated, making it easier for fiscal finance to occur. And third, there was an increasing willingness of the federal government to run deficits and accumulate debt against future taxes. The fiscal authorities were content to let the, quote, independent Fed take the lead because the politics were inclined to lend in incipient crises rather than take the risk of a panic. In other words, we have what's called in economics a limited commitment problem. It was very hard under these circumstances for the central bank not to use its independent powers to lend more expansively in crisis. The setup facilitated lending laxity and moral hazard. So for these reasons, the Fed exhibited a tendency to expand its lending reach well beyond well-collateralized temporary liquidity assistance to solvent, supervised, and regulated depositories long before the Fiducia Act of 1991 authorized them to do that. In 1970, the Fed lent to depositories in support of the commercial paper market after the Penn Central collapsed. In 1974, the Fed lent in support of the insolvent Franklin National Bank until it was purchased. In 1984-85, the Fed lent in support of the undeclared insolvency of Continental Illinois Bank. All these were expansive credit actions which, in my view, should be seen in the context of 100 years of a loosening of the Federal Reserve's ability to lend more expansively with the backing, implicit backing of taxpayer dollars. Anna Schwartz has an article in which she points out that the Fed lent to hundreds of banks in the 1980s and delayed the closure of failed institutions and increased the losses to the FDIC and ultimately taxpayers. So to get back to the story, the growing shadow banks and money markets could expect support from the independent Fed credit policy, either directly or indirectly. So in the moment of crisis, the Fed would be put in a no-win situation, deny credit and risk financial collapse, or lend and feed expectations of more expansive lending in the future. And the Fed exhibited just this in the crisis of 2007, 2009. Those of us who have been watching this for 30 years said, I wonder whether these expectations are going to work out well in the crisis. My view is that we can't see this period except as kind of akin to the Fed's loss of credibility for low inflation. The Fed has kind of got an expectational equilibrium where it's expected to come to the aid of the system in the way that the Fed would feed higher expected inflations with more money growth. Let's see. Want me to stop? Okay. All right. You can have my slides later, and there's more to come, but let me just, I can make my point. I think I've gotten to the point to say there's an analogy between the problem on inflation and the problem with credit policy, in my view. An independent central bank is very nice for many purposes. You can do things more decisively. You can have operational freedom that gets things done in the moment. But the problem is your very independence as a central bank puts you in a position where the politics can push more problems your way as a central bank. And I think that we cannot get the independent central bank structure fully secure until central bankers push back in some way against politics. I mean, in my own life, I was rooting for central bankers to become more and more independent. It never occurred to me, I was too naive, that the more independent you would be, the more the politics would push things on your plate. There's an irony here, and I'll stop with this last point. You're supposed to be, as an independent central bank, not political, but at some point, in order to make this independent central bank institution work, central bankers have to act political by saying to politicians, no more. And that, to me, is, if you will, the Achilles heel, if I can say that, of modern independent central banking. Central bankers have to act a little bit politically in order to save the institution itself. Thank you.
Yes, thank you, Marvin. Now I will not ask a question at the moment. I'll spare it for later. And I hand over to the third panelist, Claudia Buch. She's the vice president of Deutsche Bundesbank since 2014, so relatively new in her job, responsible for financial stability department and for statistics, among other things. She has been a university professor at Tübingen and at Magdeburg, and the president of the Halle Institute for Economic Research, which is a Leibniz Institute, one of the large research centers in Germany. She holds a PhD of the University of Kiel and has been a member of the German Council of Economic Advisors and also been on the scientific advisory board of the European Systemic Risk Board before joining Bundesbank. She published in her academic career widely on issues of international finance, bank portfolio policy, macroeconomics, and foreign investment. Always the focus, in a lot of her work, the focus was on financial stability issues and on bank risk-taking issues. So all those aspects that matter a lot in the current situation. She will present the view, I would say, from the Eurozone or from Germany, probably from Germany, and the evolving role of central banks in financial stability issues. So, Claudia, please.
Thank you very much, Jan-Peter. I also try to peek at the screen to see my presentation, but it's possible from here. It would be very tempting to pick up on the last things that Marvin said here about central bank independence, but I will talk about something slightly different, maybe referring us back a little bit to what Jens Weidmann has been saying at the beginning, namely the interlinkages, the interdependence between monetary policy and financial stability, or macroprudential policy, how it's what is the new term for this. And let me start off by maybe using an oversimplified summary of what is the pre-crisis view on the linkages between monetary policy and macroprudential policies, or well, maybe macroprudential policies, that term hadn't even been coined prior to the crisis. So again, at the risk of oversimplifying, there was this idea that, well, monetary policy takes care of price stability. There's microprudential supervision that takes care of the stability of the individual bank. What we didn't really have this overarching policy that has the goal of taking care of the stability of the entire financial system. And that is, of course, as we know, the role of macroprudential policy, because we've seen in the crisis that there are, first of all, high output cost to financial crisis. There's strong empirical evidence showing us that the output losses due to financial crisis are highly persistent. So it's not just a cyclical downswing, but we are really losing real output during financial crisis. And I think it also has been mentioned here before. We had governments stepping in various forms, taking over losses of banks, and this has all led us with a high stock of debt that is both private and public sector debt that is now complicating so many policy decisions. So the two questions I want to refer to here are, one, what is this macroprudential policy? How is it linked to monetary policy? And as has been mentioned already at the beginning, there's a question of, should we change the mandates for monetary policy? So is there a role for adding a financial stability mandate to monetary policy? And I would like to address these issues in three steps. First of all, very briefly, you all know the facts basically go through the mandates and instruments of monetary policy and macroprudential policy. Then I also want to zoom back a little bit in history. I'm not an economic historian, but it's just interesting to look at a couple of stylized facts on financial markets. Here I will focus on Germany mostly in the past 100 years. And then I briefly want to talk about the new roles for central bank, the new institutions that we have put into place. And I will a little bit also touch upon the issue that Jan-Peter has mentioned at the beginning, namely the need for policy evaluation and for really trying to find out whether we are achieving what we want to achieve with our new policy instruments. But let me start with this first question. So what really are these two policies? And it's pretty straightforward. Of course, it has also taken a lot of time, as we've actually just seen. It has taken a lot of time to define the goals of monetary policy, to come up with a clear idea of what monetary policy should be doing, what it should be aiming at. But in the end, it has somehow boiled down to having a well-defined policy rule. In most of our theoretical models, we have a Taylor rule describing what central banks are doing. Of course, we all know that central bankers hardly get together and just compare their notes with regard to the Taylor rule, but at least there's a kind of a consensus in the way how we think about monetary policy and how it has been implemented. And I think it's interesting to note that actually the price stability mandate of the ECB and of many other central banks has not been violated throughout the crisis. So this is already a first indication that, of course, monetary policy and macroprudential policies are highly interrelated, but they're separate goals, and we need also separate instruments to address these. Macroprudential policy or financial stability policy is, of course, more complicated. If you read the definitions that we have in our financial stability reports, be it the ECB, be it the Bundesbank, be it other central banks around the globe, we find something that financial stability should aim at maintaining the functioning of the financial system. And ensure that credit is allocated efficiently and that the functioning of the payment system is not impaired. But of course, it's much more difficult to boil that down to a simple metric, and I'm personally convinced that we will never have this one index, this one indicator that will tell us where we stand in terms of financial stability. And one of the reasons for this is, of course, that systemic risk and risks to the stability of the financial system can emanate from, first of all, direct linkages between financial institutions or between markets. But we know from many empirical studies that the second channel of contagion, namely informational contagion, fire sales, and all these indirect channels of contagion are much more important empirically. And of course, these are things that are very hard to measure, even if we improve upon our statistics. This is something that we will always have a very hard time to really put into data and into good indicators. And this is, I think, one of the reasons why financial stability will always be a different policy compared to monetary policy. Again, I'm simplifying a bit the ease with which monetary policy can be conducted. We've heard this here on the panel. Let me give you another reason why I think monetary policy and financial stability policy or macroprudential policies are different, and that refers to the targets or the addressees of these policies. So when you look at monetary policy, its execution is mainly through banking institutions as the counterparts for our monetary policy transactions. If you look at macroprudential policies and if you define them in a relatively broad way, as I think it should be done, then you notice that macroprudential policies address not only financial institutions, they also address shadow banks, maybe sometimes institutions that we don't know yet and that are not part of our statistical reporting systems. Macroprudential policy actions can also address fiscal authorities, and there's also some feedback loop to central banks, in particular if central banks are tasked with macroprudential policy. And I think this is one reason that we have a much more direct link also to the political process, that we shouldn't have macroprudential policies in the hands of central banks alone, for the reason that central banks are independent, as we have heard, and many macroprudential policy choices involve political decisions that should involve also elected policymakers. Having said that, and this has also been mentioned before, there are of course many linkages between monetary policy and financial stability. So when you think about the link from monetary policy to financial stability, there's been a lot of discussion and a lot of evidence on the risk-taking channel of monetary policy. But there's also many links or many channels that are running back from financial stability to monetary policy. So if we have financial institutions that are not viable in the long run, of course, that's impairing the transmission of monetary policy, and some of the examples have been mentioned here. But I would also like to refer to some literature that's out there and evidence that's out there, which is in this collective moral hazard framework, in the sense that, of course, we have a financial stability problem if many institutions in the same way increase their exposure to the same macroeconomic risk factor, and that might have implications for the stability of the system as a whole. So there's many feedback channels between these two policies. So now, before going into the concrete implications of all this for macroprudential policy in Europe and in particular in Germany, in the Bundesbank, let me just show you a couple of very quick graphs, which I think very nicely relate to what has been said before, namely trying to see, is what we're talking about now so much different from previous episodes, also previous episodes of financial crisis, or are we just, with the term macroprudential policy, labeling something that has been around for a longer period of time? And Jens has mentioned before the aversion of Germans to inflation, so zooming back 100 years. Here I'm zooming back 100 years, showing you a simple statistic on the size of the German financial system, if you want, measured through the volume of deposits in German banks relative to GDP. And I think it's very interesting to see that actually Right now, we're in a situation where the volume of deposits relative to GDP has a similar level as it had 100 years ago. So there was this closing down of financial markets in the war and in the post-war period, and financial markets, there was much less intermediation in between, so we have this U-shaped evolution. But now, just by this very simple metric of the size of the banking system, we're in a similar situation as we were 100 years ago. Similar picture if you take the share of funding coming from equity markets, either for financial corporations or if you take stock market capitalization over GDP. So this is not to say that our financial markets today are the same as they used to be 100 years ago, but at least some of the stylized facts look very, very similar. It becomes a little bit more difficult when you look at the integration into international capital flows, because the historic evidence sometimes is a little bit different. The numbers are not really comparable, but also in terms of financial integration, we share the current episode shares many similarities with previous episodes. So this is basically these three graphs that's putting together data from the work by Rajan and Zingales, and then updating it with some numbers we have in the back. The final picture I want to show to you is that's from the Rainer Drogoff work. It's just to remind us, I think, as we all know, that of course if we had periods of high integration into international capital flows, this was often followed by subsequent financial crisis. And this historic evidence on financial crisis and how have we dealt with financial crisis has actually very nicely been summarized by Markus Brunnermeier, who's here in the room, and Isabel Schnabel. So they go through, I think, 400 years of financial crisis and how policymakers have dealt with these financial crises. And it's actually interesting to see when you read these narratives that to some extent they sound very similar to what we are observing today, both in terms of the triggers of financial crisis and in terms of the outcomes, the policy outcomes and the measures that have been implemented to contain financial crisis. So there's always a story about deregulation of finance, lots of liquidity coming through central banks and through other channels, then a building up of bubbles, a bursting of bubbles, and then more restrictive policy measures being taken. Policy measures that we would probably label today macroprudential policies. Of course, at the time the labels were different, and we didn't talk about macroprudential policy in the same way. One of the bottom lines of this literature and of this research is that the costs of financial crisis that I mentioned at the beginning, the cost of financial crisis are much higher the longer the policy action was delayed. So in our words today, the more inaction bias there was, and the degree to which the bubbles have been financed through credit expansion. So this is kind of a common denominator that runs through many of these historic episodes. So for the sake of time, I can't possibly go through all the details in terms of adjustment in institutional structure that we have taken in response to the crisis, but I would like to highlight two aspects. One is we have put up new institutions to deal with macroprudential policies and to coordinate these policies. And the second is, and that's probably an attempt to go against this in action bias. This is just a quick slide. I don't want to go into all the details here because this is just a summary of what has been done. The detail of the matter, as you all know, is even more complicated. So we have new policy institutions dealing with macroprudential policies. The Bundesbank has an important role in that, and we've established new policy instruments trying to contain the buildup of credit. That's one of the most important factors. There are many other aspects to this macroprudential policy instruments, but containing the buildup of credit and preventing the loosening of credit standards that we've seen in many previous crises, that's an important factor here. And the European Systemic Risk Board, which has been mentioned briefly before, takes note of all these measures. So we try to establish as much transparency as possible with regard to these measures. What does it mean very specifically for the Bundesbank? Because we are talking about new mandates for central bank, and here with regard to this macroprudential policy, the Bundesbank actually has a new mandate that it has to fulfill. So we have new legislation in Germany that became effective in 2013. There are many details of this new legislation. So basically, what it aims at is to strengthen the cooperation between the supervisory authorities in Germany, the Bundesbank and the BaFin, and the Ministry of Finance. So we have a new Financial Stability Council, Ausschuss für Finanzstabilität, where we get together and discuss issues related to macroprudential policies, and maybe some of you may have taken note of it, but it was certainly overshadowed by some other discussions that we had recently. So this new Financial Stability Council issued a recommendation to establish new instruments for macroprudential policies in the real estate sector, not because we think we have an acute problem right now, but we should be prepared in case that the situation changes. And then there are many other aspects of our day-to-day work where we implement this new financial stability mandate. We have a new business area here. We contribute to many international policy groups. We put out a financial stability review. So just to sum up, what are the implications of all this for central banks? I think it's first of all a positive development that we now have a new mandate, a new policy area, macroprudential policy, which really aims at looking at the stability of the financial system as a whole. So many may argue that why do we need this? Isn't it enough to have monetary policy and macroprudential policy? But I think precisely the incentives for risk-taking, the insufficient buffers against risks in the financial system, the misalignment of asset prices, I think this is something that the other policy areas wouldn't take into consideration to the same degree. We also have new institutions to formalize this process more, because one of the concerns, of course, could be that these macroprudential policy instruments, which of course intervene into markets, into private contracts, they might have negative side effects. So I think it's a positive development that we have institutions that ensure that these instruments are used for the right purpose, that there's a comply and explain process, and that we have a structured framework for policy implementation, perhaps comparing to historic episodes that we didn't have at the time. So the policies that I've been talking about and that have been implemented in previous periods didn't have these checks and balances through an organized institutional process. What does it imply for monetary policy? I guess you would be surprised to hear something very different from me than from Jens Weidmann with regard to this with regard to this aspect. So I don't think that we would need a fundamental change in our monetary policy strategy, but of course we need to take interdependencies between the policy areas into account, and this is, I think, what we also implementing in our day-to-day work. There's, by the way, a contribution in the Bundesbank monthly report, I think, of March, which is where this argument is given in much more detail. So does all this mean we are there, we are done, we can just wait and let our new instruments, our new institutions work? I think there's still a couple of things on our agenda, apart from the fact that, of course, we have to continuously also work on the regulatory structure. And one important aspect I want to mention is policy evaluation and data. So it has been mentioned briefly at the beginning. To some extent, we are engaged in experiments, so we don't know how the new institutions work, we don't know how the new instruments work, so I think it's important that we subject ourselves to a clearly structured process of policy evaluation, that we have the right data sets available that allow us to monitor what's actually going on in the financial system. Our current monitoring systems are, of course, geared, are somewhat backward-looking, and we need to be forward-looking also in these policy areas, and ultimately using the data that we have and that maybe we still have to collect in the right way will also give us a better assessment of the interaction between monetary policy and macroprudential policies or financial stability. So there would be further readings on this, but I think I just put this up very, very quickly. And thank you for your attention. Thank you.
Yeah, thank you very much, Claudia. So we had now two interventions by Claudia and by Marvin, which both spoke about the mandate of the central bank and widening the mandate, and the point of view. I think the direction in which this mandate has been broadened is different in these two cases. Financial stability in your case, maybe more on the unemployment side in your case, and maybe we could just spend 1 minute in the panel to discuss this mandate issue. So is this a case where we need further action? Is this a broadening which is welcome? What would be your perspective, Charles, on this discussion?
Well, I very much applaud the idea of moving towards macroprudential policies. My worry is whether they'll be sufficient. I mean, they're really almost entirely untried, except in rather small city-states like Hong Kong and Estonia. I'm reminded that Mark Carney frequently says that over the last few years that the authorities have increased the equity ratio of the commercial banks. He used to say 7 times, he now says 10 times. And at the same time, he and the monetary authorities tend to say that this massive increase in equity ratios has not cut back on the amount of bank lending enormously. Now, the countercyclical capital buffers are going to be nowhere near as large as the change in equity ratios that have been applied. So what makes you think that actually this will be effective? Remember that the main kind of interaction between a housing bubble and credit expansion is on the housing side. And frequently, when you get a housing bubble, you have expectations that housing prices are going to rise at 7 to 10% per annum. Now, against that kind of expectation of price change, the real interest rate increase that you're going to establish via your macroprudential measures, I think are going to be relatively small. I'm just worrying, are you sending a very young boy to carry out a rather large man's task?
Do you want to comment? Yeah, Claudia? Yeah, and Marvin.
I'm not sure that I said this is enough and this is going to be effective. So I think I avoided those terms because, yeah. So this was basically my point. That I think we're going with all these new institutions, the new regulations. We are going into the right direction. That's for sure. So we're increasing capital buffers and we try to align them more to systemic risk. But of course, there's also an illusion. So to what extent can we actually measure systemic risk and then fine-tune the capital requirements? So I think there's a very intensive discussion actually whether, and that's also a little bit related to your question, whether we might have too many different instruments, and there's a question of how do they interact, and we won't know before actually implementing them and before testing them. So that was very much my last point, that we need to put up a system where we look at the effectiveness and where we also at some point, if we notice that it's not enough or it's too complex, where we have to step back and revise also the regulatory process. But I wouldn't take that step too early. So I think now we should be implementing what we have and look at it. And one of the problems, of course, is also related to the fact that most macroprudential policy instruments so far have been implemented in emerging markets. So the question is whether the lessons learned from those experiences in terms of elasticities of credit supply also transfer to countries in Europe and in the Eurozone. So we are engaged in large-scale projects where we try to find out, where we try to learn from the evidence that we have, what could be implications for our countries. But yeah, this is a very, very good point. So I think it's I would warn against saying that, well, now we've done everything, and I think this is exactly the point where we have to step back and establish good mechanisms for policy evaluation and maybe also revising what we have done.
Marvin, can I bring the question also to you? I mean, you mentioned that with this widening of the mandate, politicians like to push things on the table of the central bank, thereby diluting maybe the price stability objective.
Yeah, I have mixed feelings, as you might imagine, on this point. I first of all have to repeat that I think there's a great danger about getting distracted from the priority for price stability by moving interest rates to try to compensate for some other credit policy issues. I think that's a mistake. I also think we have to begin with diagnosis of what went wrong in the credit turmoil. I think there's too little diagnosis and too much cure. And my own feeling is that what Dodd-Frank did largely was irrelevant to what happened in the crisis. I'm not sure where their diagnosis came from, but I would like to always have a diagnosis ahead of what recommendations people like to make. And then finally, I think when we use the words financial stability, those words are way too broad. I think what we really have is what I would call a broad monetary stability problem, not only in our depositories, but in the US case, in what we call near money markets or shadow banks, where there's massive maturity transformation. People love to finance longer-term illiquid securities on the basis of short-term securities because the pecuniary interest that they have to pay to get money into those shadow banks is low because they can monetize the so-called liquidity services premium that people think they're getting. And we need to really deal with this as a monetary problem, which involves serious mismatches of maturity. So I think the words financial stability are misleading. I think there's a lot of the financial system that works reasonably well, or that there's very little we can do about it as central banks, and we need to think about this as a monetary instability problem, broadly speaking. And then we can talk about enlarging the mandate or not enlarging the mandate.
Yeah, Charles.
But every time there's been a real financial stability crisis, the Great Depression, the Great Financial Crisis, and Japan, it's not been the case that inflation has risen too much. Its inflation has undershot. So, and the problem has not been that we've been led by financial stability to cease to worry about inflation. We haven't even met our inflation targets. And when there's a real financial stability crisis, the problem is that the authorities do too little on both monetary policy and financial stability. Not that they sort of give up. I know that a lot of people thought that QE and the rest of it, and a massive expansion of the monetary base, was going to lead to a huge expansion in the money stock and eventually to inflation. But the opposite has happened.
Marvin, one more time, then we go to the
respond by saying I was in favor of massive QE, so I'm not sure why there's a disconnect a little bit between these comments. I thought the first job of the central bank was to create, in my words, credibility against deflation at the zero interest bound, and the only way to do that was to go big on QE initially. So,
yeah, maybe we open up for the floor, and I would ask for questions. So please, Barry Eichengreen, and I have to look around a little bit.
I thought those were...
Could you please briefly tell your name so that people know who is asking?
Barry Eichengreen. Three fantastic presentations that raised a number of questions. So one for Marvin. You suggested that the amendment to Section 13.3 was a key element in all the financial excesses and problems that occurred in the United States over the subsequent 2 decades, and asserted that there was massive evidence connecting that policy to what happened afterwards. So you can hear the skepticism in my voice. I would put Section 13.3 way down on my list of culprits for the things that happened afterwards. And for Charles, what would Walter Bagehot say about ELA? Wouldn't he say that the ECB should be lending against collateral of the Greek banks that is good in normal times, as opposed to right at the moment?
Okay, who wants to start? Marvin?
I didn't say there was massive evidence in favor of the effect of the Fiducia Amendment, but I did argue on the basis of long history, by analogy to monetary policy, that there would be a case to be made that the central banks have the same kind of limited commitment problem on credit policy as we know they had on monetary policy. I find that as at least compelling enough to provide circumstantial evidence that the 1991 Fiducia Act did make it easier for the U.S. to expand beyond depositories into money market finance of long-term illiquid assets.
Charles.
I wish I knew what were normal times in Greece. The present crisis has been going on from 2010. It's not clear when it will revert. You make, I think, a very good point, which is that when you get a panic, you do tend to get markets overshooting. And the valuations in markets at the height of a crisis are themselves not realistic. And undertaking mark-to-market and accounting under those circumstances is probably counterproductive. So you want to think about what are the likely values when the system recovers. But when will we see a Greek recovery? What is normal for Greece? What are the proper valuations that you can apply? I'm jolly glad I'm not having to do it.
So, over there, other hands.
Hello, my name is John Kamlos, and I'm a retired professor from the University of Munich. And I'd like to ask the panelists, how about the way the central banks created the financial crisis? Let's talk about that a little bit, right? After all, it was the ideology of Greenspan that looked the other way when banks lowered the underwriting standards, right? Created predatory loans. In other words, there's got to be a problem with an institution that has so much power that is not democratic and depends on a single individual. Thank you.
Well, Marvin, I think that would be a question for you.
So, I think I basically agree with you, but I want to say that Alan Greenspan had talked against, well, he had people in the Federal Reserve Board write papers documenting that Fannie and Freddie's behavior in the housing market was not going to turn out well. And to an extent, Alan Greenspan made those points public. But I agree with you, having worked in the Fed for many years, I'm very well aware of the fact that the Fed pulled its punches on the regulatory restrictiveness that it could have imposed on mortgage markets. Now, this comes to a kind of a critical point about independence of central banks. Central banks are not completely independent. There's an appointment process. And in the Federal Reserve System, we started out, a little bit of history, with a 14-year term for members of the Board of Governors. The pay in 1913, 1914 was high enough that when people got that job, they stayed there for 14 years. The pay now is so low that they are, in my words, stepping stone jobs. You get politically appointed, you stay for 3 years, and you still have to remain on good terms with your political appointees to get a job on the back end. So because the pay is so low and the term is so small, we've lost a great deal of critical independence, in my view, on the Federal Reserve Board relative to the way the Federal Reserve Act was originally intended.
And I disagree with you, because I think it's not the power of the institution, it's the power of ideas. I think that what went wrong was that we all thought, and I think I was probably as much guilty as anyone else, that if you maintained price stability, which we had, and if we maintained banks meeting the Basel II capital requirement, that everything would be all right. It was the ideas that were wrong, not the institutional structure. The institutional structure may not be perfect, it may be wrong in itself, but it was the way that the majority of people were thinking in 2006, 2007. It was not that the Fed or the central banking fraternity were out of step with everybody. They weren't. They were dead in step with the common views of academia.
Claudia, you want to add something?
Yeah, so yeah, pretty much along those lines. So it's certainly not, it's not one individual, it's not one cause. So I think there's also many causes, and now we've understood that some of the causes have been in the regulatory framework, and one of the things that I haven't mentioned in detail is that, of course, also with regard to the regulations, we haven't done our homework yet. So we think that now we've understood that for instance, there's a preferential treatment of sovereign exposures in our current banking regulations. So this is, seems to be relatively straightforward, that this is something that should be changed. We've learned from the crisis that contributes to the bank sovereign nexus. It's very hard to change politically. So we've the Bundesbank is working on that. We have it in our reports. We have a strategy for reform, but it's very hard to implement. So it's different causes, different institutions, and then of course also kind of the common sense that we have in the community. So all this plays together, and this is also why it's, I mean, we've made a lot of progress. Even against the odds, but why it's also so difficult to move the reform agenda ahead.
Maybe I can add one little question in this regard. It is the financial system at large is not a stationary thing. So there's a lot of innovations, let's say, changes how financial industry works, how business are being made, that were not really perceived, not really seen, not really known in the run-up to the crisis, and it was really the crisis that revealed that things are done differently and that we need more analysis and all that. And policy, in that sense, has to be built on serious knowledge. And if that knowledge isn't there, it's not really ideology, but it is just a missing understanding.
But it's worse than that, because the problem is, even if you see the present perfectly, when you introduce regulation, that changes the world. It's the old Lucas critique. And having changed the world by changing the regulation, the financial system will innovate in the context of the new regulatory system in a way that is almost impossible to foresee in advance.
Now, this is a famous law, I have to say. So we go to Philip.
So you spoke a lot, Philipp Hartmann, you spoke a lot about the lender of last resort, almost all of you, and I cannot resist the temptation to ask you, what is the geographical limits or scope of the lender of last resort in a monetary union of independent states, and are there stark principles that would determine that, or is it something you take step by step? So I would be curious to see how you would describe that from your angle. Should that be seen? And if you had lessons from history, I'm sorry, if there are any lessons from histories from previous currency union that were made up of independent state that would teach something about how to go about that problem?
I defer to Claudia on the details, but my understanding is that after a point, that ELA remains the responsibility of the National Central Bank, so that when there becomes the question of possible losses, that this remains the responsibility of the nation state within the Eurozone. And I cannot remember now the Latin monetary union, but I would guess exactly the same was true, that during the course of the Latin monetary union and the Scandinavian monetary union, that any form of lender of last resort remained the national responsibility.
Marvin, yeah.
I'll dive into this and say, of course, that's fine, but at some point, you know, there's a possibility that ELA loans might be collectivized, and so there's a decision that has to be made, whether you like it or not, of when enough is enough. My thinking, based on the Federal Reserve's own experience and based on the Fed being drawn, in my view, over the long sweep of history, ever more deeply into credit policy actions that it's more problematic. I'll repeat what I said. The central bank needs to draw the line. No one will draw the line for it. It needs to draw the line and try to respect that line. And that's where I say, and I think this doesn't matter whether you're in a monetary union or not. The Federal Reserve is in the same boat in a way, although it's not as evident to people. And this is the idea I was saying. Central banks need to push back. We need to draw the line, and if you will, we need to be political, because the line is not something you can just do on an arithmetic basis. That's, as I said before, the Achilles heel of our modern independent central bank institutions. So,
you said every monetary institution, or is this something one could avoid? So could we have a redefinition of the responsibility of the central bank such that this fuzzy area doesn't happen?
Another way to put it is to say that credit policy in and of itself does not afford a bright line like monetary policy does for independent central banking. It's the nature of the beast. The credit policy is harder when push comes to shove to just say yes. Inflation is something everybody can measure. I think that the central banks should be more definite about the boundaries of their credit policy reach, and should do it in advance so that people understand that. But it's very hard to do because we kind of, you know, this is a kind of a work in progress. Let's just stop there.
Yeah. So there's a hand in the middle. Ah, yeah.
So I'm Francesco Barbadia, and I would like to ask a very simple question to the panelists, also taking into account what the president of the Bundesbank said in his introductory speech. And my simple question is, have we solved the possible dilemmas between monetary and financial stability? Have we solved it either because price stability and financial stability coincide perfectly, or have we solved it because we have two targets, two tools, interest rates and macroprudential policies, and so we can deal with the Tinbergen paradigm? So I would like to have your answer to that. My answer is that no, we have not dealt with this in any definitive way. We are struggling to find practical solutions, ad hoc solutions, we muddled through, but we have not dealt with this dilemma in any definitive way, and so, okay, we have to accept that we have to live with this very unsatisfactory situation.
Marvin, you want to start?
I mean, just in short, I don't see this as a technological dilemma. I see this as, if anything, a political dilemma, having, again, I'm kind of like a broken record, having to go back to the specification of our overall governance relationship between central banks and other parts of the government. So monetary policy, for me, deals with price stability, the stability of the purchasing power of money. It's beautifully suited to do that. It can do that. It shouldn't be distracted from that. I think that facilitates financial stability, but credit policy should deal to a degree with financial stability, and so would regulatory policy, and these can be, in principle, governed independently of monetary policy. I don't see any technological dilemma. I think the dilemma is how to organize the society's application of these tools to the respective objectives.
Claudia, you want to say something? No.
I've little to add compared to what I said in my talk. It's probably a bit of a simplification. This is a simple question. I mean, this is the most complicated question that we have, and so the difficulty is, of course, that as I've said, that we have defined the goals of monetary policy and what is price stability. And financial stability is something much broader, and this is also why the interactions between financial stability and monetary policy are complicated. We haven't talked much about where to draw the line between macroprudential and microprudential policy. So I think in that sense it's not that easy to say there's this one goal for financial stability apart from the very abstract definition that I gave you. And also the set of instruments is more complex, but I think conceptually it's useful to distinguish the two policy areas, understanding that there are these strong linkages and connections that I've tried to sketch.
I agree with you that we haven't resolved the problem, but I think that we think of the problem perhaps in the wrong way. The way that most people tend to think of the problem is that if you worry too much about financial stability, you might ease up so much that you endanger price stability. And I would again remind you that when financial stability problems have occurred, the problem has been that it's been too much deflation and not enough price stability. And so that in a sense, financial stability and monetary stability, price stability, do tend to go together, complementary. And I think my great disturbance about what the ECB did was that following the onset of the financial instability, they abandoned what Ottmar Issing always argued for, which was concern about making sure that monetary aggregates grew fast enough. The monetary aggregate growth in the Eurozone collapsed after 2008, and the ECB simply said this is what you would expect when there was a crisis. The ECB should have done more to try and ensure that the monetary aggregates and price stability hit the targets that they had set themselves before. They did not. They were not sufficiently expansionary. The problem with monetary policy during periods of financial stability, great difficulties, is not that monetary policy sort of forgets and allows inflation to go ahead, is that the monetary authorities don't do what they said they would do.
Yeah, Marvin?
I want to second what Charles is saying. Absolutely true. That if things are done properly, I think there is a complementarity between the two.
Mm-hmm. Okay, maybe is there some more question? I don't see. As a maybe concluding question, is there anything in terms of lesson that we can take from the UK or from the US experience that would tell us at the current moment in the Eurozone what could be a next step forward to a, let's say, more consistent mandate for the central bank? I'm particularly concerned with the fact that we, of course, have a monetary union, but we don't have anything else on the political side, on the fiscal side, that would in some sense back it up. Is that a necessary requirement for the monetary policy to work or not?
So this is a question that says, given where we are, what should happen next? You know, it's very hard for me as an economist to say that, because we're best at imagining what should be done in the future, or imagining ways to go in the future. I think, in large part, this has become a political mess because the rules have been fudged, in my opinion. I'm a U.S. citizen, and so what I mean when I say political, when the rules are fudged, then things are political. And then it's hard for me as an economist, and I think other economists, to say what should happen next, because it's largely a judgment call. I will say one thing about Greece. Greece is going to have to adjust. It has an international adjustment problem. You know, the standard of living is too high to be sustained, and that needs to happen. And that can happen in one of two ways, or maybe more. You know, have a flexible exchange rate again, or accede to some external finance to help you adjust under that program. There are really two ways to the same end. And if people would see that, I think it would help maybe find one of the two ways to be successful.
I think I should defer any answer until the UK has voted to to remain within the European Union, which I very much hope it will in the near future.
Okay, Claudia, as a last word.
Yeah, so it's hard for me to judge from the point of view of the UK or the US, but I would like to answer that question from the point of view of the new institutional rules that we have given ourselves in Europe. I think that's often not very well understood, that we have actually established after the crisis a new institutional framework that goes far beyond the issues that we've been discussing here in terms of hardening, strengthening the Stability and Growth Pact, and we have a crisis mechanism. I'm sometimes surprised how little this is understood in the public when you hear commentators, and I think this is my biggest concern, that now we have to also ensure that we live this new structure and that we put it into force, because that I think is going to strengthen the credibility of this whole framework that we've been putting up.
Okay, so thank you very much, panelists, and thank you, the auditorium, for asking questions. I think we are at the end of this first session, and we have 2 or 3 more panels to come that will cover the other areas that relate to monetary policy and what are the tensions to other fields of economic policy. I want to thank you as I did before, and I wish us all a nice coffee break, which is starting now.